Welcome to G&T's Q2 2026 market update. This quarter, the market story is not simply that construction demand is weakening on economic uncertainty. It is that demand is weakening while cost risk remains stubbornly high. New orders are softer, project conversion is slowing, and more schemes are facing viability pressure. But at the same time, clients are not yet seeing a broad-based easing in pricing. This is because the market is still absorbing several layers of cost pressure. The cost of borrowing remains a particular issue. Even where base rates have been held, market borrowing costs can still move higher as investors price in future interest rate expectations, inflation risk, and wider uncertainty. For development, that matters. Higher funding costs continue to affect viability, especially where schemes are already sensitive to debt costs, exit yields, and project returns. That is particularly important for projects with longer time horizons, such as major infrastructure programs where multi-year investment decisions are being made against a more uncertain inflation, funding, and geopolitical backdrop.
The other major shift this quarter is the impact of the Middle East conflict. This should now be seen as a central source of renewed cost risk, not a secondary market trend. Energy volatility is feeding into fuel, freight, logistics, shipping, and imported materials, with knock-on effects for wider headline inflation. It is also affecting pricing behavior in construction. We are seeing more qualifications, selective material price increases, and less appetite to hold fixed prices with shorter validity periods where exposure is uncertain. Materials have therefore moved up the near-term cost-risk hierarchy. Labor pressure has cooled at a headline level, although specialist skill supply remains constrained. Materials are now the sharper near-term pressure point, particularly where packages are exposed to energy-intensive production, freight, metals, insulation, clay products, and imported components. This is not a repeat of the broad 2021 and 2022 material shock, but it is enough to change the way that contractors and suppliers are pricing risk.
The biggest live pressure point remains MEP and specialist electrical packages. For many schemes, MEP is where the market feels most difficult. We are seeing pressure from specialist labor, supervision, commissioning, long lead plant, controls, fire compliance, and imported components. On complex, services-heavy projects, the MEP package is one of the main factors determining whether a scheme can be priced and delivered with confidence.
And softer demand does not automatically solve that. Contractor capacity may start to ease as future pipeline weakens, but many contractors and specialist subcontractors are not necessarily short of work today. In some areas, they remain selective, particularly where design information is immature, programs are tight, or risk transfer is heavy. So while better buying opportunities may emerge, they will be selective rather than universal.
That is why our tender price view remains nuanced. Our Q2 tender price indicator is forecasting UK tender price inflation of 3.5% for 2026, with London slightly higher at 3.75%. But the average does not tell the whole story. Tender price inflation is becoming increasingly project-specific. Well-defined, viable schemes with mature design, realistic programs, and balanced risk allocation should be best placed to benefit if capacity eases later in 2026 and into 2027. But complex or poorly defined schemes are likely to continue attracting cautious pricing and risk allowances.
For clients, the message is clear. Do not assume that weaker demand will automatically mean lower tender prices. The opportunity is there, but only where projects are properly prepared for the market. That means early engagement, clear scope, realistic programs with good design, and a close understanding of MEP and material exposure, as well as risk allocation that the supply chain can price with confidence.
In short, pipeline momentum is weakening, and today's pricing environment remains risk-heavy. The winners in this market will be the clients who understand where the real pressure points sit and act early to manage them.
To read the full Q2 market update, visit our website or get in touch today to discuss how this affects your project.